Hey everyone, this is Brent from Wolf on Wall Street Trade with a market update for the week ending November 8th, 2019. Monday is Veterans Day, so thank you so much for your service. Happy Veterans Day. The stock market will be open, but the bond market will be closed, so it could be a little bit of a quiet day. So let's jump in. The S&P 500 was up 85 basis points this week. Take a little bit of a closer look, and you can see this is the week. So a lot of small bodied candlesticks, stars, doji stars until Friday, and we'll get to that in a minute. So up 85 basis points for the week, just shy of 1%. The most obvious driver of trade this week, even more so than last week or really the last month, has been trade news. But there were other things as well. There's a big fear of missing out trade on both the retail and institutional side, and we'll get into that in a minute. There was a big move in sector style rotation again, like September. We had a big rotation between value and momentum. And while the market's kind of, sideways, small stars did close up on the week, one of the other really huge things that happened, Federal Reserve rate cuts were completely priced out going out to December of 2020, not December next month, a year away. It appears to be the market taking Powell serious, that they're not going to be cutting rates again anytime soon. And of course, according to Powell, they're not going to be hiking rates, which is, pretty much a given. But I think this whole trade deal thing played a huge role in that and influence in that. We'll take a look at that too. So here's the week right here, starting from Monday. This gap up was Wilbur Ross saying that there was good progress made on trade talks, basically jawboning the market higher. And this is the open on Monday after all these comments over the weekend. That's about half of the week's gains right there. And then notice when there's no real trade news driving it, the market's just kind of sideways here. So no real data, economic data or trade news Tuesday, no favorable news on Wednesday. Market's kind of slumping. Then going into Thursday, in the overnight session about 2 a.m. in the morning, there was a headline out of China. I think it was their foreign minister. And it said an agreement, the two sides had reached an agreement to phase out all tariffs. Well, this headline was mistranslated. But as you can see, the market did not care when it came to the open on Thursday morning, gapped up on this news. So here was kind of the mistranslation. It's kind of silly that the entire market depends on a mistranslated headline. The news was that the U.S. and China had reached a deal to roll back all tariffs. So you can see why the market gapped up on that. However, what he really said was that all tariffs should be rolled back if a trade deal is agreed. Then later that afternoon, there was news that there was fierce opposition to this idea in the White House, so the market came down a little bit. And then on Friday, Peter Navarro said that there was no agreement on existing tariffs. Market just kind of went sideways most of Friday. This was a professional markup at the end of the day. It happened over here last Friday too. So what happens is if you can move the S&P 0.25%, then all weekend you'll hear on CNBC, new record highs, and that drives this whole FOMO trade, this fear of missing out. Let me show you what happened in the Dow. It's even more ridiculous. This is a 5-minute chart, so this is Friday. This was Thursday's close. This is that ramp to get the Dow green on the day, because it was not green on the day, and had the new record high headline on CNBC and every other place. Look what it did. I mean, it was up 2 basis points. It's not even visible on the chart, but it is officially a new record high for the Dow Jones. And as soon as the market closed, new highs in S&P, new highs in Dow. This is driving that FOMO or fear of missing out trade. But this is a very specific drive by professionals to mark up prices into the close. The rest of the day was pretty much doing nothing. And here is part of that FOMO that I was just talking about, the fear of missing out trade. This is CNN's Fear and Greed Index. I don't usually look at it very often because it's really doesn't say much most of the time, but when it's at extremes, it becomes a contrarian indicator, a contrarian signal. So extreme greed, 91. This is up from 80 just a week ago and up from 30 a month ago. So we were into that fear area, not extreme fear. So this is where it is, extreme greed. And let me show you what this looks like over a longer term basis. And here it is. So we're up here in extreme greed. Now remember the melt up at the end of December 2017 into January 2018. This is where that extreme greed was then, so we're well above that right now. At extremes, this is a contrarian signal. So December of 2018, when the market had sold off about 20%, we were in extreme fear. So contrarian signal, market recovered. Up here, we're at extreme greed, contrarian signal. As far as actually moving the market, there wasn't a whole lot of activity this week on 3C charts. It is still negatively divergent on a relative basis, but there are a lot of short squeezes that are what's behind the moves, and those are all related to this trade news. I'll show you what I'm talking about. So this is the week. Here's Monday, here's Friday. 1 minute chart. This is 3C on the SPY. So you can see really almost no activity. There was a short squeeze over here into Monday. Over here into Thursday, there was a short squeeze, and as soon as that short squeeze ended, it just fell off. There was no follow through in buying. And then this is that professional markup in the last hour of the day, Friday, to get the averages into record close territory, so you could hear all about it on CNBC over the weekend. This is the S&P 500 5-minute chart on the week, and this is my most shorted index. Okay, it's an equal weight index of the most shorted stocks. Here is a major squeeze into Monday's open. This is where half of the week's gains came from. You can see another squeeze here on Tuesday's open. Here's the one I was just showing you on Thursday's open. And then into Friday, it looks like the shorts were covering in anticipation of headlines over the weekend that maybe could go against them, because the market is taking pretty much any positive headline and rallying on it, and then ignoring the negative headlines. And that's just all part of sentiment. The stock market is one of the greatest examples of an indicator reflecting mass psychology, and mass psychology right now is giddy bullish. Like last week, IWM or small caps had the most active 3C chart. So this is the week 1 minute chart, and you can see these highs being sold into, not really aggressively, but there's just nothing behind it. So this kind of reminds me of professional distribution. Markup stocks on news stories, sell to retail. So strong hands selling to weak hands, that's distribution. It's a process, it's not an event. Given that the trade news is driving the market, and this week it kind of got a little bit more mixed, not so positive, there's an interesting development on the price charts. It's just starting to develop. Okay, a lot of trend lines here, but this is a 5-minute chart. This is the week. So this is the kind of trend, 3-week trend. So the bulls are in control. But look what happened this week. You see this diagonal trend line in this one? That is a broadening price formation. It's not perfect in the S&P 500. It is developing in a few other places as well. A broadening formation, and we have a huge one going back almost 2 years on the S&P 500. Here it is on a daily chart. A broadening formation has 3 pivots at the high, 1, 2, and 3, and then 2 pivots at the low. Typically, there's a couple different versions of a broadening formation, but what it represents is a market that does not have intelligent sponsorship, that's being whipped around by wild and chaotic news or rumors. So back here on the 5-minute chart, considering the news and rumors going back and forth this week, it's not too surprising to see this kind of a broadening pattern. Here's the NASDAQ. You can see the same kind of formation developing in here. Here's a 3-week uptrend, so it's right along that uptrend. But this is kind of what I'm seeing in a few different areas, these broadening patterns. IWM, a little bit different. It's a rectangle or a lateral range. Here are those opens that I said, there was no support for. It looked like they were selling to weak hands. So we have this range over here that pretty much goes between 158 and 160, where it seems like there's resistance there or selling taking place there. Here is its uptrend line coming in around 158 next week, which is also right here at the bottom of this range over the last week. Getting back to that broadening formation, semiconductors have been moving a lot on the trade news because they're very sensitive to trade news. They stand to benefit from a deal, and they're high beta, which is part of the rotation everybody's been chasing recently. So if we take a look at those, they have a similar broadening formation this week. And notice that, like IWM, comes up here selling all gains from the day, up here selling all gains for the day. S&P sector performance this week also depicts this very optimistic tone about the trade deal. So it's been all cyclical sectors that are gaining. The best performing was energy, and you can see most of the gains were put in early in the week, and the rest of the week it's trading in this. It's actually a bullish symmetrical triangle, so it's a bullish consolidation. This was the best performing sector. And the other best performers were industrials at 1.9% and financials at 2.5%. Financials are benefiting big time from the steepening yield curve and from higher rates. Bonds got smoked. Rates went very high. I think something like 20 basis points. But on the other side of the market, the worst performing sectors are all rate sensitive and defensive. So like take real estate, down 3.7% on the week. The other worst performing sectors were utilities, down 3.65, and consumer staples down about 0.6%. So this is part of a cyclical bias, good news about the trade deal or good feelings about the trade deal, getting out of defensive sectors, and big rotation again between momentum and value. There was something interesting though in sector performance. Consumer discretionary did not participate at all. It lost about 0.25% on the week, kind of ended a little bit ugly over here at the end of the week. Notice that on a daily chart, it's making lower highs, not participating in the rally, which is interesting because it is a cyclical sector that should benefit from positive trade news. And it is consolidating in this large descending triangle. This is actually a more bearish development. And here you can see this week. So it looks like it's going to probably head down to this 120 trend line and test that. What's the big stock in this sector? I brought it up a couple weeks back, Amazon. And the reason I brought it up was because it looks like a head and shoulders top, not just in price, but also volume with the neckline down here about 1700. Hasn't gotten very far since I brought it up. Still trading in what looks like a head and shoulders top. I think there's something wrong with this sector. Consumer discretionary, not participating. Biggest stock in it, not looking very good. Okay, so here's utilities. This is a daily chart. And you might remember from all my past videos until really the last month, I was saying all the defensive sectors are the only ones making new highs. Utilities, real estate, consumer staples. Okay, so this reflects the market anticipating or pricing in recession. It's moving to these very defensive sectors. So that changed this week. You could see that rotation out of them. I'll show you that in a minute. So here's XLU close to breaking this uptrend. This is part of what was really a big rotation under the surface this week. Like I covered in September, we had a similar rotation between style factors, between momentum. This would be a momentum sector. Even though it's defensive, CNBC gets us very confused. They think that momentum only means technology stocks. No, it means these defensive stocks that have been trending higher. So what's happening is that all these funds that have been long momentum, and they've been long these defensive sectors, they've been long recessionary fears, they're now forced to try to protect these gains and unwind positions here and rotate out of momentum and into value. Otherwise, all their gains on the year are going to disappear in the next couple months, is their fear. Anyway, that's what's going on. And all this trade optimism is playing a big role in that. Here are these two style factors. This is momentum in green, and this is value in red. And this is the start of the week. You can see this huge rotation. Value over here outperformed momentum by about 240 basis points, or about 2.4%. This is the institutional hedge fund managers, all that, all trying to chase this value trade and sell out of their momentum that they've been long all year. And that's been mostly defensive sectors. So an example of a value sector would be energy, because it's been beaten up so bad this year. Here's a daily chart of energy. You can see it just really did not recover from that October to December 2018 sell-off. Hasn't made new highs. It was one of the first sectors to go red for the year, and now you're seeing this chasing in energy. Amid all this rotation, amid all of this FOMO, fear of missing out, chasing the trade war headlines, expecting a trade deal, market participation or breadth is not great. This is the S&P 500 in green, and this white line is the percentage of all stocks above their 40-day moving average. So here's that melt-up rally into January of 2018. That was about 71%. Over here early in the year, February, where everything changed when the Fed went neutral, got up to about 88% over here. It's now at 57%. Okay, and you can see the trend going down, less and less participation as the broader index is going higher. And here's a 60-minute chart. This shows us the rally from June into July, and over here August into September, and our current one in October. And you notice what happens when breadth starts weakening or participation starts weakening, get kind of in this toppy zone. We had very good participation in September, And over here, we are divergent. So the average is going up and breadth is kind of going nowhere. There's fewer and fewer stocks participating in this. And like I said last week, there's only one sector as of last week that confirmed the S&P's new high. That was technology. Industrials confirmed this week. So you have 2 out of 11 sectors that are confirming that. And also, as I pointed out recently, new lows are increasing on this rally. So here's the rally. Notice how new lows are increasing. That should not be happening. In fact, it may be easier if I just overlay this. And let me dial the transparency down a little bit. So here's the sell-off from August. You have a lot of new lows. That's normal. That's what you expect to see. You get a sell-off, new lows increase. But look at the rally over here in September. What did new lows do? They decrease. That is what you should see. Over here in October, what are new lows doing? They're increasing as price is increasing. This is not what you want to see. Number one, new lows going up as the market's rallying. And number two, they hit the highest point of this entire rally on Thursday when the market was an all-time new high. We saw the same thing into September of 2018 before that October sell-off. It doesn't mean the market's going to sell off. It just means participation is not good under the hood. Another interesting development over about the last week and a half, almost 2 weeks, is relative strength and volatility. Here's VIX's daily chart. You look at this, you're probably saying, what? Are you crazy? What are you talking about relative strength? Well, yes, believe it or not, relative strength, except for Friday, when there was really an all-out effort to suppress volatility to help the averages close at record highs. So I watch the market so closely, I can spot these things, intraday. I'll notice, the S&P's up 0.2% and volatility's up 1.5%. A lot of days like that this week. You don't see it in the trend. You can see it if you pay attention to the market very closely or you look at correlation. So this is a daily chart, S&P 500, and this is the 10-day correlation between VIX and the SPX. So normally volatility trades almost inversely or opposite of the S&P 500. So normally we'd expect the correlation to be down here, almost opposite, very, very low. When you get relative performance in volatility, sometimes it's not noticeable on VIX's chart unless you look very closely. You can see the correlation with the S&P rising. So back here into January of 2018, VIX and the S&P were actually trending higher. So you got this big correlation spike. Now this is 10-day correlation. If you get a 30-day correlation spike, it is called every major market top in the last 2.5, 3 decades. We got one of those spikes right here, and the market has been in, or the S&P has been in a broadening formation ever since. You know what CNBC was saying back here when people started noticing that VIX was going up? They said that VIX going up was a sign of bullishness. How wrong were they? 10% sell-off, volatility exploded. Notice over here, the same thing happened in September of 2018, near the record high, before 20% sell-off. And then over here, I called this one out. In April, the market was rallying all month over here on trade news, on trade optimism. You might remember Steve Mnuchin from the White House came out, or actually he's the Secretary of the Treasury, came out and said that the trade deal, not just beans for tariffs, but the comprehensive trade deal covering all the thorny issues was 90% done and could be signed in 2 weeks. And what I said at the time was, I think somebody knows something is going on with that trade deal that is not so hot. My members heard about it for about 3 weeks before I pushed out this tweet. Notice the date, May 3rd, 2019. I don't tweet about this stuff often. The correlation was spiking. Interesting. Maybe someone knows the U.S.-China trade negotiations aren't going as well as the market believes. That was Friday, May 3rd, right there. Sunday at noon, that weekend, the trade talks blew up and Trump instituted new tariffs. Market sold off. So if we look at the 10-day correlation now, it hasn't spiked above 0, but it has risen all month. Notice this rise. That is the highest level since May 20th back over here when we got a 4% second leg down. The 5-day correlation, however, did spike. So the longer this goes on, 10 days is medium term bearish. 30 days, you're looking at a cyclical top in the market, at least in 4 of the last 4 instances. As mentioned on Friday, they drove down VIX hard to get the market to new record closing highs, so you can see that over here. And here's that selling pressure in 3C on Friday. Notice it's leading prices lower. If we just walk back a little bit, we had pretty much positive divergences all week. So prices of VIX futures down here, 3C positively diverging. And then in Friday, selling pressure, selling pressure, selling pressure. You can see it here in the volume too. That was all to get the major averages up to record closes. This is the fingerprints of institutional manipulation, you could say, trying to get that record close and drive the FOMO trade. Amid all this FOMO and sentiment being extremely, extremely greedy or bullish, the net shorts in VIX actually increased to a new record. As a reminder, they did that into January of 2018 when VIX spiked over 300%. This is another sign of massive complacency. In commodities, you also saw that cyclical bias this week. So here is crude oil in blue, copper in orange on the week. Here is gold. Absolutely got pancaked, down 3.2%. This is representative of that cyclical bias, buying crude, buying copper, selling defensive gold. And I kind of talked about this last week in terms of inflation being a risk, and that's part of what the market is celebrating, basically, that there will be growth because of this trade deal. Also, the dollar and the yields completely retraced all of the FOMC, so rising dollar put pressure on gold as well. If we put TLT over gold in white, you can see the same thing. So safe havens being really sold aggressively this week amid that cyclical risk on trade deal bias. Now, despite the drop, gold is still in this big bull flag. You might remember last week, or for members, I've been saying if I was long gold, I would have a stop here. I'm not long gold yet. Let's take a little closer look on the 60-minute chart. I'll zoom in. Actually, let me go to a 15-minute chart, but you can see here is the big flag trend lines. This is that stop area or trend I was talking about. And on a 15-minute chart, there's the break of that trend. This is kind of a bearish consolidation here. It's not quite a flag, but it hasn't recovered. It hasn't kind of turned up. It's kind of bearish like this one. So because of this consolidation, the fact that it has not gotten back above, let's say the flag here, at least 139, 140, it leaves it open to a decline of about another 1.4, 1.5%, or GLD down to 135.50. And what that would be is just a second leg or second measured move down. So we'd be looking at somewhere in here. So I'm going to just continue to watch gold. I do like this big bull flag, but these things can take time, and gold is under pressure for quite a few different reasons. Yields up, safe havens being sold across the board amid this trade optimism, and the dollar completely retracing all of the FOMC knee-jerk losses. So crude oil up about 2.5% on the week. Here you can see the week. Let me show you something else. Remember those broadening formations we're talking about in risk assets? Boom, right there in crude too, one of the better developed ones. It's not perfect because we haven't hit this upper trend line. Again, you usually have 3 points of contact with that upper trend line, but this is a broadening formation, just like we saw in the averages, sectors like semiconductors. And what a broadening formation represents is a market that lacks intelligent sponsorship, that is being whipped around by wild rumors, aka the trade war news. Here's the 10-year yield in the candlesticks and the US dollar index, or UUP, in white. You can see here's the FOMC knee-jerk reaction. This is this week, so massive, massive move in yields that put pressure on those defensive sectors, up about 20 basis points with the dollar. This was one of last week's red flags. Consolidation had dropped a lot on the FOMC knee-jerk. Here is this week, and what is happening over here is, first on Tuesday, the market completely priced out all Fed rate cut probabilities. Here are the target rate probabilities for December 2020, not next month, over a year away. The current Fed funds rate is right here, 150 to 175 basis points. Probabilities point to it being exactly the same a year from now. So just a couple of weeks ago, next month's December meeting had about a 50% chance of a 25 basis point cut. Now, almost 13 months out, they expect rates to be exactly the same. This is trade optimism. This was on that Chinese mistranslated story. So what was a red flag for stocks last week has become supportive, defensive sectors down, and then you have the cyclical sectors up with yields. So here's the daily chart. You can see it has been consolidating in this big triangle. Gold has been consolidating over here in a bull flag. And zoom in, notice this week breaks below that trend line. Now it did not make a lower low over here, so you still have an uptrend, but it's definitely getting more chaotic and breaking this trend of basically recession fears and concerns over the trade war to less recession fears and less concern over the trade war. Now, like gold, it does have a probability of slipping a little bit more. Let's take a look a little bit closer. So this is a 15-minute chart of TLT, and this is this week. Like gold, it did not get back above these trend lines. It has this kind of, not quite a bear flag, but it is at risk for another decline if it does not get back above this 137 level and hold it fairly quickly. There was decent support buying interest over here at the low on Tuesday. Here it is on 3C. So here's the low on Tuesday. You can see 3C is still positively divergent. We got to bounce off that. I had some people make some really good money on that bounce. But into the end of the week, notice what 3C is doing. So if TLT can get back above 137, it's in a lot better position. 3C does not look as good as it did over here on Tuesday. If it dilly-dallies around in here and does something like this, then we have a bearish flag, and the probability is that we get a move down to about 131, about 2.5 to 3% lower. That's just a measured move, a second leg down from here. So I'll be watching those 3C charts very carefully of TLT as well as Treasury futures. Now before we get off bonds and yields, one more thing to keep in mind. This is the 30-year yield. This is it going down on these recessionary fears and really slowing growth, which growth is still slowing. And here we have that September rotation. Remember, value momentum, and we have this big move in yields this week that is causing that rotation again. What you have to be aware of is rising yields are good for stocks right now. But if they spike too fast, it's very dangerous for stocks. I'm not talking about a specific level in the yield, the 30-year yield. I'm talking about how fast it moves. Let me show you with a rate of change. This is the 5-week rate of change. Okay, so look at the spike here. Look at the spike here. The spike this week is even bigger. So in terms of rate of change, it's a very fast, big move. Let me show you why this matters. I'm going to change this to the S&P 500. So this is the weekly chart of the S&P 500, January 2018, September of 2018, and where we are now. This is that rate of change in the 30-year yield, 5-week basis. Notice when yields spike quickly, market comes down. That was really the catalyst for this sell-off in October, the spike in yields. That was because of something Powell said, and here we have that spike in yields again. It's not about an exact level in yields, it's about how quickly they rise and shock the market. Price action this week is not as bullish as it was the past 2 Fridays. So the past 2 Fridays, we had a bull flag over here, a bullish ascending triangle over here, but we do have that exact same professional markup, professionally executed into the weekend as we did last Friday. Do not have that bullish consolidation though. The S&P's big, almost 2-year broadening formation is still there. It still has the 3 pivots to the upside, 2 pivots on the downside. Now, keep in mind, with broadening formations, it's a chaotic pattern. They don't respect trend lines as well as consolidations like triangles or rectangles or anything like that because it is chaos. It's slightly above. It's not above enough to void this pattern. Until it does, I still see this as a broadening top. The red flag in USD/JPY from last week is no longer there. It is supportive of stocks this week, and that's the same for yields. The red flag in high yield credit is still there. This is a massive divergence. I pointed this out last week as a red flag. S&P 500 higher, high yield credit negatively diverging. High yield credit, especially HYG, is an institutional asset for expressing a risk on position, and institutional money typically tends to lead the broader market. So high yield credit tends to lead the S&P 500. You can see over here where it negatively diverged at the high in July, the market came down. We have a big negative divergence here. This is a really big red flag. If we take a closer look on the week, here's the start of the week, Monday, also not confirming the S&P 500 on the week. Sentiment is extremely frothy, as you can see, fear and greed index into extreme greed, and also at the highest it's been really since 2017 when the market was in absolute melt-up mode, and right here before the sell-off in 2018. And this, of course, is all being driven by trade news and optimism of that news. So again, the market is a reflection of mass psychology. Mass psychology right now is extremely positive about a trade deal getting done. Keep in mind volatility's relative strength. Just check in on it a couple times a week. See if the S&P 500 is up and what volatility is doing. Is it up or is it down? The 10-day correlation is the highest since over here in May before we got a second leg down. And this was a really high correlation coming into April, basically as the market expected a trade deal, expected not just beans for tariffs, but all the issues were 90% done and would be signed in 2 weeks. We now know that that was far, far from true. These broadening formations, they're starting to show up in a few places like the S&P 500, the NASDAQ, semiconductors, crude oil. Those same price formations occurred right here as volatility relative strength was building in April before that trade deal was supposedly going to be signed. Here it is, right here in April. Let me roll this chart back on a 60-minute. Here we are on a 60-minute chart. April into May of 2019, trade deal was supposedly going to be signed. Broadening formation in the S&P. We had another one in the Dow. This is a right angle broadening formation. We had another one in NASDAQ, another right angle broadening formation, and in IWM small caps, broadening formation. And this is when I put out that tweet about the correlation of VIX being very high and maybe the market was going to be surprised by negative trade news. Here's what happened next. And the current correlation between volatility and the SPX is the highest since here, which was the second leg down for the S&P 500. So I think these broadening formations that are starting to develop this past week may be reflecting the same uncertainty starting to creep in, represented by price action. The bulls do still have control. Here's that trend line probably coming into 30.65, 30.70 next week. And the trade negotiations are expected to be wrapped up on the original deadline, which is Friday, next Friday. Of course, they were said to be done back here 4 weeks ago. And remember that Monday is going to be a holiday. It is Veterans Day, so the bond market will be closed. I think price action will be relatively muted. It might help stocks a little bit on Monday. In the meantime, I would expect these trade stories and rumors and news to dominate next week's trade. So that will do it for this weekend's video. Thank you for listening. If you liked it, please give it a thumbs up. Happy Veterans Day to all the veterans out there. I truly do appreciate your service. Everybody have a fantastic weekend. It's about 75 degrees out here in Florida, South Florida, with a nice light breeze, so I'm going to go enjoy it. I'll see members on Monday.